Welcome back, everyone, to Sip and Talk.
Hey there. You know, I swear, everything is AI-powered these days. It's everywhere.
Oh, totally.
The stock market, my neighbor's smart toaster. I'm pretty sure my fridge is judging my late-night snacks using advanced algorithms.
Huh. Well, maybe it knows something we don't.
Yeah.
But seriously, it feels saturated, doesn't it?
It really does. Like, are we just slapping AI on everything?
Yeah, but look, this AI wave, it feels structurally different from, previous tech booms. We're talking foundational economic change here.
Okay, different how?
Well, the IMF, for example, forecasts AI could boost global GDP by a whopping 7% over the next decade. 7%.
Wow, okay, that's a staggering number. Huge. But you got to read the fine print. That kind of boost, it fundamentally reshapes labor markets' capital distribution.
Exactly. It's not just growth, it's disruption. Big time.
Right.
So our mission today on Sip and Talk is really to cut through that noise. We want to tackle that crucial question for you. Is this AI moment a sustainable economic revolution, or is it just, another massive bubble waiting to pop? We're going to unpack three things. First, the macroeconomic evidence. What does this creative destruction thing all about in the context of AI?
Okay.
Second, we'll pinpoint the three high-growth sectors where the capital seems to be flowing right now, looking ahead.
Got it.
And finally, the part lots of people are asking about. We'll break down a potential strategy for capturing that growth, specifically thinking about 2026 through 2028.
Sounds good. But look, super important clarification before we dive in.
Yeah.
Our discussion of specific companies, investment strategies. It's all based on objective market analysis. It's for education only. Seriously, it's not investment advice. Please do your own research.
Absolutely crucial. Okay, not investment advice. Right, let's get into it. This economic revolution, starting with the theory. We hear this term, creative destruction. It sounds, dramatic.
It's pretty dramatic, yeah. And that concept, originally Schumpeter's idea, has this powerful modern framework now. It even got sort of validated recently, right? Yeah, economists Aghion, Howitt, and Moker just got the 2025 Nobel Prize in Economic Sciences for work related to this. The timing is perfect.
Right.
Because AI is like the textbook example of what they call a general purpose technology, or GPT. Not the chat kind, the economic kind.
Oh, okay. A general purpose technology. So how does AI fit that GPT mold? What does that mean?
Well, a GDT, think like the steam engine or maybe the internet, it does two things at once. It accelerates creation, so innovation, new companies, efficiency gains, all that good stuff.
Right.
But it also accelerates destruction. That means the rapid obsolescence of old structures, old jobs, old processes. AI is simultaneously the fastest creator and, honestly, the most efficient destroyer of old ways we've seen in decades. It's intense.
Wow. Creator and destroyer. And didn't Moker also add something about the conditions needed for this?
Yeah, Mosker's point is key. Sustained creation, the good part, needs an open environment for knowledge, both the, scientific what we know knowledge and the practical how-to knowledge. But if a society or an industry tries too hard to resist the disruption part, protect the old ways too much, the whole economic engine can just seize up. You don't get the growth.
Right, you need both sides of the coin. So let's talk data. Is this creation side actually measurable right now? Are we seeing it in the numbers?
Oh, absolutely. It's definitely measurable. Beyond that IMF prediction, which was, about a steady 0.5% annual bump to global GDP between 2025 and 2030.
Yeah, 0.5% per year.
Consistent.
Exactly. Beyond that, we see massive capital shifting in foundational stuff. Look at the U.S. private AI investment hit. Get this, $81.7 billion in 2025 alone.
$81 billion in 1 year.
Yep. And that single investment stream accounted for an astonishing 46% of the entire U.S. GDP growth, coming just from information processing equipment investments. 46%. From just AI-related investment. This isn't just like another software update. It's core infrastructure driving growth.
Totally. It's fundamental. And then there's the productivity leap, at the worker level. We've heard about that too.
Yeah, tell me about that.
Well, Goldman Sachs, they estimated that automating just 25% of work tasks globally could boost labor productivity by 15%. 15%.
That's huge.
And maybe even more interesting, the Stanford AI Index found AI boosts task-level productivity by 10 to 20%. But here's the surprising part. It seems to narrow the skill gap between lower and higher skilled workers.
Really? Narrows it? How?
Yeah, it suggests AI might actually be democratizing some high-value work, kind of leveling the playing field a bit, giving more people tools to do more complex things.
Okay, that sounds incredibly optimistic. But this brings us back to that darker side you mentioned, Aghion warning about the destruction part.
Correct. That's the big worry in Aghion's model.
Yeah.
Look, innovation needs some temporary monopoly profits to incentivize massive R&D investment. Think about a chip giant like NVIDIA right now, right? They're dominant.
They need that return on investment.
Exactly. But Aghion warns if those monopolies become too entrenched, too powerful, and stick around too long, they end up suppressing the next waves of innovation that are supposed to follow. They block competition.
So instead of sustained growth, you could get stagnation because the big players lock everything down.
Precisely. And what about the immediate human cost? We talk investment, returns. But we have to acknowledge the pain point here, right?
Yeah, the destruction isn't just about old tech, it's about people's jobs, too.
For sure. The models predict potentially severe transitional costs. We could see short-term transitional unemployment spiking maybe 5% to 10% in the most affected sectors.
5 to 10% is significant displacement.
It is. And crucially, AI is expected to significantly increase inequality. It's predicted to raise the Gini coefficient, that's a measure of income inequality, by 0.05 to 0.1.
Okay, unpack that Gini increase for us. What does 0.05 to 0.1 actually represent in real terms?
That rise, it might sound small, but 0.05 to 0.1 represents a really serious structural shift in wealth distribution. It means substantial capital, moving away from labor income towards capital owners and those, superstar firms.
So the rich get richer, potentially much richer, while others might struggle.
That's the risk. If we don't manage this transition carefully, the innovation engine succeeds, sure, but societal friction could escalate dramatically. Policy has to focus ruthlessly on anti-monopoly action and massive workforce retraining to try and manage this painlessly, or at least less painfully.
Yeah, that policy challenge is crystal clear. How do you incentivize the innovation without just cementing permanent inequality? It's a tough balancing act.
Huge challenge.
Okay, let's ground this analysis in market reality now. If that theory holds creation and destruction, where's the money actually flowing in the U.S. market? Looking ahead to, say, 2026, 2028.
Okay, so shifting gears to sectors. We see three areas where that creation phase seems to be accelerating fastest, getting the highest capital flows right now.
All right, give us number one. I think I can guess the one.
Okay, probably. Number one, artificial intelligence and machine learning, AML itself. No surprise there. This is the core engine. We're forecasting the highest compound annual growth rate, CAGR, at around 38 to 42% for the next 3 years.
38 to 42% CAGR. Wow.
Yeah, driven by generative AI expanding into basically every enterprise application you can think of. And the U.S. market.
Yeah.
Still dominant, holding about 70% share of the global AI market right now.
Okay, so chips, foundational models, the core tech, that makes sense as number one. But what's the indispensable infrastructure link? What allows this massive growth to actually happen and sustain itself?
Good question. That brings us to number two, renewable energy. This covers wind, solar, battery storage, green hydrogen, the whole green energy complex. We're forecasting a strong TAGR here too, maybe 28 to 32%.
Okay, renewables. Why is that so tightly linked to AI growth?
This is a brilliant example of that creative destruction idea moving sideways across industries. Think about it. AI data centers. They are incredibly power hungry. Predictions are they could consume a staggering 10% of global electricity by 2028.
10% of global electricity just for data centers? That's massive. An immediate, non-negotiable demand increase.
Precisely. You cannot build these AI factories without power. Lots of it. And that explosive demand forces utilities to invest immediately and heavily in new capacity. And guess what kind of capacity is getting built, especially with policy support like the IRA extension?
Green capacity, renewables.
Exactly. So the growth in data, in AI, is directly forcing the creation of a massive new green power grid. It's a direct link. The digital revolution requires a literal power revolution.
Fascinating connection. Okay, that's the power source. What about the third pillar? Where else is AI driving major creation?
Number three, biotechnology and healthcare. Biotech. We project a high CGR here as well, maybe 22 to 27%.
Biotech. How does AI fit in there?
The link is the speed of discovery and Personalization. AI is dramatically speeding up drug discovery, things shortening clinical trial timelines, identifying targets faster. It's also enhancing diagnostics, personalized medicine, even gene editing tech like CRISPR.
So AI isn't just analyzing data, it's fundamentally changing how we discover and deliver healthcare, creating the next generation of human health.
Pretty much. That projection you hear about the personalized medicine market doubling by 2028, that shows the massive scale of this shift. It's disrupting those old, slow pharmaceutical R&D models.
Okay, AML itself, renewables to power it, and biotech transforming health. Those are the three big growth areas. Now let's talk strategy. How can someone potentially tap into this growth? Our goal, you said, is the middle road.
Yeah, the middle road approach. We're looking for high growth potential, something that could beat the S&P 500's projected 8 to 10% CAGR, but crucially maintaining reasonable stability. So we're aiming for a portfolio beta around, say, 1.2. Not wildly speculative, but definitely growth-oriented.
Balanced high growth. Okay. Let's look at maybe 3 individual company examples first, one from each of those sectors you highlighted.
Sounds good. Naturally, we have to start with NVIDIA. It's the essential creation engine in AML, right? They've got, what, over 80% market share in AI chips. The predicted KGR is huge, 40-45%.
Okay, hold on. A 45% CAGR is fantastic, obviously. But the valuation, isn't the PE ratio like 60 plus odd? That seems incredibly high. Isn't that the very definition of a potential bubble? How do you justify that kind of risk in a longer-term strategy?
That's a really important question. It goes back to that GPT framework and the idea of a moat. The justification, if there is one, lies in NVIDIA not just selling a chip, right? They're selling a whole proprietary ecosystem, CDA software, developer networks, architectures.
The ecosystem lock-in.
Exactly. That dominance, that ecosystem, potentially allows them to dictate pricing and maintain market share much longer than in previous hardware cycles. So you're essentially paying a premium for owning the core infrastructure of this whole global economic shift. But yes, the valuation risk is absolutely there. High reward, high risk.
Okay, that clarifies the moat versus momentum argument. It's a bet on sustained dominance. All right, what about a stable pick for the renewables link?
For that indispensable cross-sector link, consider NextEra Energy, NEE. It's an established utility company, so it offers essential stability. Its beta is low, around 0.9.
Okay, stable, but does it have the growth?
That's the interesting part. Its growth is predicted to be high for utility, maybe 25-30% CAGR, driven directly by that non-negotiable demand for green power from all those energy-hungry AI data centers, plus policy support. So it kind of balances stability and high growth almost perfectly for this theme.
Utility stability with tech-driven growth.
Oh, nice.
And the biotech powerhouse example.
Let's look at Vertex Pharmaceuticals, VRTX. It's a large cap company, over $100 billion market cap, so it's established. But it's leading the charge in areas like gene therapy, especially for cystic fibrosis. Their projected CAGR is also strong, maybe 25-30%.
And the AI connection?
They're successfully using AI in their R&D, which speeds up that creation cycle in drug development. It positions them really well for that predicted doubling in the personalized medicine market we talked about.
Got it. NVIDIA, NextEra, Vertex, leaders in each key area. But look, investing in just 3 individual stocks is risky, right? For diversification, we probably need a broader approach, like ETFs.
Absolutely. That's where the balanced ETF approach comes in. The goal here is to capture that creative destruction theme across the wider tech-driven economy, not just betting on 3 specific winners.
Yeah.
You don't want to just buy, say, a broad tech ETF like XLK or VGT and call it a day. That might miss some nuances.
Right. It might be too narrow. So what's the proposed middle road ETF portfolio look like?
Okay, so we designed a hypothetical 3-fund portfolio. It's 100% tech exposed, but diversified across different layers of the tech ecosystem. The aim is to hit that target beta of around 1.18 and a target CAGR somewhere in the 18-25% range.
Okay, what's the allocation?
The allocation is 40% in VGT, the Vanguard Information Technology ETF, then 30% in IGV, the iShares Expanded Tech Software Sector ETF, and the remaining 30% in XLC, the Communication Services Select Sector SPDR Fund.
Okay, 40% VGT, 30% IGV, 30% XLC. Walk us through the rationale. Why VGT as the biggest chunk, and why the even split for the other 2?
Right, so VGT gets the 40% anchor because it holds the core, relatively stable, essential AI infrastructure players. Think Microsoft, NVIDIA, Apple. It's the solid foundation.
Makes sense.
The other 60% is split evenly between 2 key disruption layers. IGV, the software ETF, captures that high-growth destruction and application layer. It holds companies like Salesforce, Adobe, maybe Palantir, depending on the index rules at the time. It's the software disrupting older business models.
Okay, the application layer.
And XLC, Communication Services, captures the platform shift, the disruption in communication, advertising, content delivery. Think Google, Meta. These are the companies leveraging AI heavily on the consumer interface and advertising side. XLC also tends to have a slightly lower beta, around 1.10, which helps balance the portfolio's overall volatility.
Ah, I see. So VGT for infrastructure, IGV for software disruption, and XLC for platform communication disruption. It covers multiple angles.
Exactly. The balance ensures you've got exposure to every layer of AI acceleration, the physical building blocks, the software applications, and the consumer interface, while trying to maintain that target volatility profile, that beta around 1.1.
So the big takeaway here seems to be you don't necessarily need to panic and chase super high volatility in riskier niche pure play funds to avoid that fear of missing out, that FOMO.
Right. This kind of diversified approach aims to capture the broad structural shift with more managed risk while still targeting significant returns, potentially well above the market average.
It's about diversification within the technological disruption itself.
I got it.
Okay, let's try and summarize then. This AI moment, it really does feel like more than just a temporary trend. It looks like a structural rewiring of the global economy. Creative destruction in overdrive.
Absolutely. And our ability as a society to actually convert this immense potential into sustained, inclusive prosperity. That depends entirely on making wise policy decisions going forward.
Going back to Agin and Moker.
Yeah. We need to be able to incentivize the NVIDIAs of today, like Agin suggested, give them room to innovate. But crucially, we also have to be ready and willing to curb or even break up those monopolies tomorrow if they stifle competition. Ensuring that free flow of knowledge, Moki stressed, is so vital.
And the immediate challenge, the one we can't ignore, is managing the pain. The transitional unemployment that predicted increase in wealth inequality the Gini coefficient warns us about. That needs real focus.
Big time. But hey, let's leave you, the listener, with maybe one final provocative thought to chew on. We mentioned that the Stanford AI Index found that AI seems to be narrowing the skill gap, right? Empowering lower-skilled workers to perform higher-value tasks.
Yeah, that was a surprising finding.
So think about this. If AI starts to level the playing field for technical expertise, if specialized knowledge becomes more democratized through this general-purpose technology, what's the most valuable human skill left in the marketplace?
If AI provides the technical answers.
The question you might want to ask yourself is, are we heading toward a future where our greatest economic value isn't our technical know-how, but maybe simply sound human judgment, critical thinking, empathy?
Something for you all to think about. We really hope this session of Sip and Talk helped you understand some of the powerful forces shaping the market right now. It's a complex picture.
It really is. Hope it was useful.
Thanks for tuning in. Remember to subscribe to the Sip and Talk podcast wherever you get your podcasts.
Yeah, please do. And also, check out our friend Mickey's YouTube channel. It's called Mickytolife. Lots of fun stuff over there. Memes, spirits tasting, cool European travel vlogs. Just good fun.
Definitely check out Mickytolife. All right, that's all for this time.
See you soon on the next Sip and Talk.